Sometimes you're forced to sell stocks, crypto, or a house at a loss. The motivation for selling something for less than you paid for it could be monetary, if you just need the cash in your pocket, but it also could be a way to stop the bleeding before you lose too much money. And while gains on the sale of assets are not all taxed at the same rate, losses are also treated differently. So let's talk about carry-forward losses and how to use them in the future. Losses on the sale of assets are treated differently. You're not able to deduct more than $3,000 of capital losses against your income in any given tax year. So if you sold AMC for a $4,000 loss in 2021 and you have no other sales or gains to offset that loss, then your 2021 tax return will show a $3,000 reduction of your ordinary income, your W-2, Schedule C, K-1, and you'll be able to use the $1,000 left over to reduce your income in 2022. Now let's say you sold it for a loss of $30,000 and you swear off trading for the rest of your life. Every year, for 10 years, you'll be allowed to take a $3,000 loss against your other income. Now if you sold it for a loss of $30,000 but you have gains of $25,000 from crypto sales, then those two amounts net together and you only pay tax on $5,000 of gains with no carryover into the future. So, you're only allowed to deduct $3,000 per year unless you have gains to offset the losses sooner. Otherwise, you'll continue to carry over your total losses and use $3,000 every year until you use them all up.